Welcome to Everyday Investor. My name is Nicole Edmonds, and I'm filling in today for Rav Toor. Today we're going to be talking about how we can make money investing in value-add multi-residential properties. Grab your pen and paper and don't go anywhere. Everyday Investor begins in a moment. Coming up, Politis teaches us how our money can make us money investing in value-add multi-residential properties.
We're not relying on passive appreciation. We're going in there and actively adding value to the asset that we're buying. So just because we're not building the entirety of the building doesn't mean we're not meaningfully renovating the building in order to increase those rents. So we're not relying on the market just to appreciate in order to make us our returns.
Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own, invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. I'm Nicole Edmonds, filling in today for Rav Toor. Today we're going to be talking about how we can make money investing in value-add multi-residential properties. Remember, before getting involved in any investment opportunity, you always want to ask 4 questions before you start. 1, what is my return on investment? 2, when do I get that return along with the money I put in? 3, what is the minimum cash amount needed? And 4, what is the risk in the worst case scenario? We have Politis with us today. He's the CEO of Greybrook Realty Partners, here to tell us about making money with value-add multi-residential properties. Peter, thanks very much for being on the show.
Thank you for having me.
So Peter, before we dive in, what's new with you and what's new with Greybrook?
You know, we continue to grow. We're fortunate enough to have exposure to a lot of different development-based opportunities around North America. So, you know, we're delving into the ultra-luxury market here in Toronto and in South Florida and Miami. We've been building purpose-built rental buildings in core cities in the U.S. and buying value-add properties across major urban centers in Canada and continue to develop here in Toronto.
Yeah, that's interesting because what I've experienced from what you guys do has been more from buying land and developing it and selling it, whereas now you guys are getting more into a whole different strategy. Talk a little bit about that.
Yeah, I mean, the unique thing is that people think of development as I'm buying a raw piece of land, I'm building a home, I'm selling it, and then I'm done. And, you know, value-add multi-residential properties are not too terribly different. It's still development-based, but instead of having to go through, let's say, an approval process or building a whole building, I'm essentially buying a building that needs a ton of renovations in order to increase the values or the rents, and then we're still selling that property. So it's a bit of manufacturing in the sense that I'm continuing to renovate lobbies, elevator banks, common areas, and units in order to increase the income and then increase the value of the asset when we sell it. Kind of the buy and hold strategy is I'm buying it, I'm hoping that the market goes up and someone pays me more. Here, we get some of the benefit of the buy and hold, but we're really creating the value by renovating these residential units. You know, we're taking, you know, old 1960s, 70s, 80s units and putting granite countertops and putting new appliances in there, stainless steel, and new floors and wood and toilets and bathtubs and all those things. And you take an old apartment and you get to essentially re-renovate it and rent it like a new apartment.
Okay, and so you're mentioning like old buildings and putting in granite countertops. Is that kind of the range of quality that you guys are doing? Is it really low end and going to really high end?
Yeah, I wouldn't say it's low end to high end. The way that I explain it is kind of like a traditional, you know, 60s, 70s, 80s apartment building that was built that maybe wasn't the lap of luxury, but it was, you know, very appropriate for families. And these are units that are typically bigger on average size, so they're very rare and they're a good place for families who can't afford to own a house to rent in these types of units. So we're taking kind of old parquet floors and maybe 70s, 80s, and 90s kitchens and saying, you know what, we can bring you new hardwood floors, we can put stainless steel appliances, granite countertops, new showers, and for a couple $100 a month more, you can have, you know, all the benefits of a new apartment, but in the space of these older buildings.
Because buildings back then, they were just built with more space. There wasn't as much demand for the pieces of land in these bigger cities. Is that what you're finding?
For sure. I mean, there's not a lot of apartments that are built today that families can live in. And the truth is that the ones that are big enough are renting for a lot of money in the urban cores, let's say Toronto or Montreal or Ottawa, that they become unaffordable for these families. And this type of housing is actually massively in demand, and it's really a fixed supply. We're not making any more of these buildings. In fact, in some cases, we're knocking these buildings down and turning them into other things. So it's an increasing demand for this type of housing, but a fixed or slightly decreasing supply.
Okay. And so from an investment perspective, how does that work? Is it a developer doing this, or are these people that are investing in these
Sure.
all together? How does that work?
So, Greybrook's lucky enough to have over 7,000 active investors in 30 different countries, and we have a lot of large-scale institutional investors who also invest with us. So, in our multifamily value-add strategy, we have a combination of our institutional investors and our everyday individual investors who partner. Us, in partnership with our value-add partner called Marlin Spring, are buying these assets, and we, in conjunction with Marlin Spring, are doing all the renovations, the construction, the increasing rents, re-renting the units, and ultimately we sell these assets. And investment ranges can go from, I would say, 3 to 5 years, but mostly 4 to 5 years in terms of the total duration of a project.
Okay, that's how long it's taking to go through and renovate the entire building?
Yeah, I mean, sometimes we'll renovate 50% of the building, sometimes we'll renovate 75% of the building. It really depends on how many people we're seeing moving out. So we'll have a history of saying, 15% of the people in this building move out every year. So over 5 years, we'll renovate, 60 or 70% of the units, as some people that move out in the future could already be the renovated units.
Okay, yeah. So tell me a bit about that. If you're buying these and they already have tenants in them, what is that turnover? Are you waiting until they naturally move out and then renovating them, or what is that?
Yeah, I mean, that essentially a building has what we'll call natural turnover. So every year, depending on the building, the location, so if it's right next to a university, typically your turnover will be higher because you have more students renting. Let's say it's a little further off of university, but more for families, that turnover rate may be a little bit less. But we have all the historical turnover data from the buildings from years past, and then we really just run our numbers off of how many people can move out and how many we can renovate. And then, it goes to one of the original 4 questions of what is the risk?
Yeah.
I mean, these buildings have been full for 30 years. That's really about the downside, is that these buildings exist, there's income, they're making cash flow.
You've seen that there's demand to live there.
Yeah, the
got all this
demand to live
history.
there isn't the issue. It's let's turn people over and get them out and increase the rents. That's really how we make the development aspect of our money.
Yeah. Okay. And so you guys are getting in there and doing, what are you renovating? What are the tasks that you're seeing the greatest return or the most value?
Yeah. So there's really 3 areas that we focus on our renovations. One is inside the unit, which we'll talk about. Then you have the general common areas, meaning, I'm going to make you a gym or a better gym or a pool or a rooftop amenity or whatever. I want to renovate your lobby. And separately, you will have what's called a capital expenditure, or CapEx, which is, we need to redo the underground garage, we need to redo a roof or things like that. So before we buy into these buildings, we have large professional organizations do, building condition reports to know where money needs to be spent, where kind of you can't see, where money we want to spend in terms of increasing the rent, so either in the common areas. And inside the units, we've done everything from, paint and new flooring to paint, flooring, kitchens, bathrooms, low flow toilets, units that aren't individually metered for hydro, we individually meter them for hydro. So there's lots of different ways. And we find a lot of the people that own these buildings are really just families or people who've been collecting an income, who haven't really been focused on increasing the rents or creating and driving value. They've more seen it as the buy and hold strategy, where they're just taking a cash flow check every month.
So you're seeing that these current owners are just families. They're not big real estate tycoons that are...
Yeah, I mean, some institutions have owned them for a long time. Those exist.
Yeah.
But a lot of the reason they bought them originally was for the cash flow aspect of it, and not the ability or the yearning to invest more money into it to increase the rent. So it's really a different strategy. And we see buildings that, are in prime places that you could increase the rent 25, 30, 35%. All you have to do is renovate the units a little bit.
Yeah.
And that wasn't the original owner's strategy. So we're coming in and we're taking over. So I don't want to say the buildings were neglected, but let's say that they weren't continuously upkept as much as they otherwise could have been.
Yeah, and a lot of investors, I find, don't have that flexibility to look at, okay, this property cash flows, so it's working, but there's so much more potential from doing a renovation. That just might not be the strategy they've used and where their experience is.
Yeah, I mean, especially if you're used to getting a check every month. Imagine you're an investor, you're like, the first of the month I get a check, and now it's saying, wait a second, not only do I not get that check, but I have to put more money in, because in the future, I'll just keep getting my check. Right? There's a lot of that's going on in the apartment building world.
Yeah.
And we're coming in and saying, listen, we'll pay you a very appropriate price because we know we have the ability to increase these rents and increase the value and ultimately make a very good return.
Okay. Whereabouts are you doing these projects? Where are you finding these buildings?
Yeah, I would say that we're focusing on, I'll say broadly the top 10 cities in Canada, but really we're focusing on Toronto and the Greater Toronto Area, Ottawa, Montreal, Quebec City, and Gatineau. Like that's been really the focus on where we are, because these are major urban centers where institutions and insurance companies and pension plans and large wealthy families globally would want to buy these assets once we're done for stabilize that cash flow buy and hold item. But we're also seeing a lot of rental increases. I mean, in Toronto, the previous 12 months rent increased over 9%, over the last 12 months over 5.5%. And in Montreal, you're seeing major increases in rent, and similar in Ottawa, believe it or not. So these places, and the rents have been so low for so long, because a lot of times the current owners are just renewing leases at basically the same. You know, my parents have owned a condo in downtown, and I was having a conversation with them recently, and until last year, they hadn't increased the rent in 9 years. And I said, what do you mean you haven't increased the rent in 9 years? Well, the tenant's so nice and he pays his rent and blah, blah, blah. And then the rent had more than doubled in terms of what they could have been getting versus what, no wonder the tenant doesn't complain.
You can't let yourself get behind if you're in that situation, because everything else is going up, your taxes, your insurance, but a lot of investors aren't doing that. Well, we've got a lot more to talk about. I want to dig in a little bit more to these locations, but we have to take a quick break. When we come back, more on investing in value-add multi-residential. Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own, invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. We're talking to Peter Politis. He's the CEO of Greybrook Realty Partners, and we're talking about how we can make money investing in value-add multi-residential properties. Peter, before we went to break, we were talking about the different markets that you guys are doing this in. Do you want to speak a little bit more to that and kind of why you're finding those markets to be the ones to make sense?
Yeah, I mean, we're doing this strategy both in the U.S. and Canada. And in Canada, we're kind of focusing, like we said, on kind of top 10 cities, but mostly kind of Montreal, Quebec, Ottawa, and the GTA and Toronto. But in the U.S., we're looking at stuff in, like, I would say the top 30 largest cities in the U.S. So we've recently bought stuff in Houston. Our partners own stuff in Dallas and Cleveland and in Miami and different other major markets, where we're looking at stuff in California and some stuff in the Panhandle, like in Tampa and other places. So we continue to look for basically places where rents have the ability to increase because jobs are increasing, because vacancy rates are low, and then really taking advantage of the ability to add value in that way.
Okay. And so how, as investors, how are people making their return? What kind of returns are they getting? How does that work?
Yeah, so really we're targeting kind of like a 15 to 16% on an annualized basis for the term of the project. So depending if it's 3 or 5 years, obviously your total ROI will increase, but we're kind of looking for a 75 or 80% ROI over a 5-year period for our value add investors.
Wow, okay. And is that coming in all at the end, or is it coming in throughout?
Yeah, that's a good question. I mean, our US strategy and the value add has actually typically a cash flow that's paid, I would say quarterly.
Okay.
And the cash flow can range from 5 to 9%, so typically averages about 7% throughout the duration of a project. But the really, outside of the income along the way in the US, the development gain or the value add bump will come when we sell the assets. In Canada, typically there's little to no cash flow throughout the period. And similar to our development projects, the gain is all made at the end when we sell the buildings. But the unique thing about these kinds of investments is that you don't have a lot of variations in the time. Because the building is built and we don't have to go through a zoning process or a construction process, you know, when we think of the projects, 3 or 5 years, not that our development time cycles aren't pretty accurate, but it's very rare that we go longer in terms of holding an asset than we otherwise would. Okay,
and that's, you're going in, you're changing the countertops or painting or doing whatever you're doing. And are you doing that, like how big are these buildings? Are they 6 unit? Are they 6 unit multiplexes? Or are they bigger?
Yeah, so typically we'll buy buildings that don't have at least probably 100, 150 units as like a bare minimum.
Okay.
But we don't really buy typically only 100 units at a time. So we'll buy portfolios of buildings. So when people are investing, they're investing in between 350 and 650 units at a time on average. So it could be a couple big buildings. It could be, we recently bought 7 buildings in Montreal and Quebec City that had 650 units in aggregate.
Wow.
So yeah, you're talking about large scale value add. It's not, we're pulling our money together and buying a $5 million asset. Our Montreal acquisition in Quebec City was over $100 million.
Okay, so walk me through a little bit the return. You're buying something like, for example, that Montreal building for $100 million. You're putting in some money, increasing the rents, and selling it. How does that break down?
Yeah, sure. So typically, depending on the location, the unit, and the level of renovation, we'll put somewhere between $10,000 and $25,000 per unit in renovations just inside the unit.
Okay.
And typically we can spend something similar in the balance of the building. So whether it's lobbies or common areas or party rooms or gyms or whatnot. So we're spending millions of dollars in increasing the value of the properties.
Yeah.
And then for every $100 in rent increase that we get, the value of the unit goes up by about $30,000. And we're buying these units for probably depending on the location, anywhere from $120,000 to $300,000 a unit. So every $100 means $30,000 in increased profit for the unit.
Huge scale when you're going across that number of units.
Especially when you get $100 or more in year one, and then you can add $50 in year two or $30
with those rent increases
and
each
continue
year.
to get those rent increases. So the value you can add over a 5-year period, especially relative to what we're paying for these units. And the really amazing thing is that I couldn't buy these units and replace them for the price that I'm buying them for, and that's really key. So we buy what's called below replacement value. So if I'm buying a unit in Montreal for $200,000 a unit, if I were to build that unit today, it would cost me meaningfully more than that to replace that unit.
Okay.
So you can't actually replace the inventory that we're buying, and no one can compete with the rents, even with our increased rents, that a new building would need way more money in rent in order to make any kind of a similar return. So we have limited competition in that kind of rental environment.
Right, and that's just because they're older, they're pre-existing, is that right? That's why you're buying them so much lower than...
That's 100% correct.
Yeah.
Today, in some places, just the municipal charges alone equal to what I'm paying for some of these units.
To build, the municipal charges to build.
Correct.
Yeah,
correct.
Wow. Okay, and talk about as an investor, if I wanted to get involved in these, how much money do I need? Because we're talking about purchases of $100 million. How much would I have to come up with?
$100 million.
$100 million. No problem.
Yeah. Well, for you, no problem. For others, our minimum investments have and always continue to be $25,000 on an individual basis. But we have investors who invest $5 and $10 million in a project. We have investors who invest $50,000 in a project.
Okay.
And we have institutions who invest tens of millions of dollars in a project. And the truth of the matter is that every investor gets the same terms and conditions. So it doesn't matter if you invest $50,000 or $5 million, other than owning more or less of a project, it's kind of the same returns. And you get to choose the location and the project and the portfolio that you're invested in.
Oh, you do?
Yeah, so you don't give me $1 and I put it wherever I want or I see fit. You say, here are the buildings, the portfolio that we're buying, here are all the metrics, would you want to participate?
And then from that, where does that money need to come from? Do I need to give that to you in cash, or can I use it from my RRSP?
Yeah, so you can invest in your personal name through cash, through a corporation, through an RSP, a TFSA, an RESP. Even in the US, our 401ks and our IRAs are available. So we have a diverse ways in which you can invest ultimately.
You're buying these buildings, holding them for say 3, 4, 5 years and selling them. You're buying them from, you said like a family who might have owned them for a while. Who are you selling them to?
Yeah, I mean, a lot of times you have pension plans, insurance companies, REITs, or just really ultra wealthy families who want to do exactly what you said, which is just buy and hold the cash flow. They want a stable asset. They have a building that's been, a lot of the units, if not all of them, have been renovated. The lobbies have been renovated. At this point, they're collecting a coupon or a check every month, and it's really a stable source of cash flow. So we're selling to some of the biggest institutions in the world.
Okay, interesting that it's going from, maybe people who wouldn't, your later buyers who don't see the value, and you're getting in there, adding that value, and then selling it over to them.
I mean, I've seen some institutions who just bought them for the reason of cash flow and never budgeted or don't have a plan to, invest millions and millions of dollars back into these buildings that ultimately they'll sell them, will do the value add work, and institutions that are the exact same or similar will buy them back at the end.
Yeah, they just don't have the stomach or the know-how for that part of the middle.
Or just their investment strategy, and that's where the bucket of money is, and they don't have the bucket of money to do that, so they sell it and move on.
Yeah, okay. Let's talk about the risk.
Sure.
What's the risk from an investor point of view in getting involved in a deal like this?
Yeah, I mean, the unique thing here is that we really feel the downside of buying units below replacement costs in major urban areas in buildings that are full to be very low to your capital. Now, the things that can fluctuate are how many people move out every year depending on various things may increase or decrease my ability to renovate the units and increase the rents. But if less people move out, what you'll find is that the ability to increase the rent the next year when they do move out is more than it was that previous year. So if you don't get the capture in that given year, in year 2 or in year 3, you'll get that bump rent increase. So it's a very, very good value proposition from a downside risk to an upside reward.
How does your team decide what to buy? When you're looking, do you look at a lot of projects, and how do you decide what's worthy?
Yeah, I would say that we probably see between 50 and 75 different value add opportunities that I would consider real. Like, we might see double that will be dismissed on size or location very quickly, but kind of real opportunities. And we'll typically buy, I would say, 10% of those, so like 5 to 7 portfolios or buildings in a given year.
Okay.
And Greybrook has and our partner Marlin Spring, a full asset management team that comes in and underwrites and dissects, and we travel to these buildings and we look at the rent roll and the tenants and what the CapEx does. I mean, it's a very hands-on business. And before we go out and buy something, we have a very arduous due diligence process that goes from talking to our property managers, to our construction managers, to leasing agents, and we even go visit the leasing offices on site to talk to the people and say, who's renting these units? Where do they work? What do they say? What do they want? What are they missing? So it's a very hands-on experience in buying these things, and we have a very, very strict criteria as to what does and does not make sense for us.
And so you're having to analyze the whole market and the resale value, but also the tenant market, right? So it sounds like there is a lot to analyze.
The tenant market and the turnover and all those things, and also for us, it's actually as detailed as what month are we buying them? Are we buying them in January or February where fewer people move out? Are we buying them in September when a lot more leases are renewed? So it gets very intricate in the details, but it's actually very cookie cutter in the sense that you can take these investment thesis and analytics to different markets across North America.
So, and how many have you guys done?
Yeah, I mean, we have over 2,500 units that we own today and that we've bought in the last 6 months alone.
Wow. Okay. Very active, very fast. Well, unfortunately, we've run out of time, but just really quickly before we end the show, so I just want to confirm, as an investor, if I'm investing money, I'm not involved in this renovation per se.
I'm happy to have you come and put on a hard hat and do all the work, but I think that's part of what us and our team does. It's meant to let your money work for you rather than working for your money, and that's something that most real estate investments don't allow you to do because it does take you time, energy, and effort, but that's what we're here for.
Yeah, awesome. Okay, well, thank you so much for coming, Peter. That was very, very interesting content.
Thank you for having me. Thank you.
And thank you to our audience. Whether you're watching on TV, online, or listening to the podcast, thanks very much for tuning in. For more information on this show or any other episode you've seen of Everyday Investor, visit our website at everydayinvestor.com, or to become an Everyday Investor Insider and receive investment opportunities, tips, and advice, you can visit our site. We'll see you next week, same place, same time. Thanks, everyone.